So this question is called Margie. It's from the 2010 P2 exam set by the current examiner. The examiner has given us some assistance in the sense that he's broken it down. Notice that there are quite often 2 marks in these written questions for the clarity and quality of discussion. Keep it simple, make it easy to read, and you'll get the 2 marks. Don't try to overcomplicate things, and make sure you have things broken down in sections. So I'm going to deal with it bit by bit. And what we've got to ensure is that we make an honest attempt at each part of the question, and in doing so, what we'll be able to do is to come up with an answer which will pick up at a target's 13, isn't it? Your first target in every exam is 13 marks in a section B question. So the first thing that we have here is a wheat contract, and I read through it, and I pick up, it says Margie wishes to treat this transaction as share-based payment under IFRS 2. And it's also treating the contract as part of its hedging strategy. Well, I'm going to say a couple of things. First of all, this is not a share-based payment issue. Because we are not taking delivery of the wheat. Share-based payment is where you are paying for something which you are buying. It can either be employment services from your employees, or it could be a physical product from a supplier. The contract does not fall within the definition of a hedge per IFRS, because firstly, we are not hedging against the movement in the fair value of an existing asset or liability. So therefore it will not be classified as a fair value hedge. A fair value hedge is where we've got something in our accounts and we're worried about its value going up or down. Well, here we're just going to issue some shares. And secondly, it does not relate to a highly probable cash flow. Therefore, it is not a cash flow hedge. It's not a fair value hedge, not a cash flow hedge. So each of these points, you see the approach I'm taking, 2 lines, bullet point style, very much geared towards trying to maximize my marks. So what are we talking about? The contract appears to be a derivative. Next word. Because firstly, there is zero cost at inception. Secondly, the value of the contract varies due to the movement in the market price of wheat and Margie's share price. Thirdly, it's settled at a future date. So it satisfies all three elements that we look for in a derivative. So make sure you're familiar with some of these key definitions in relation to financial instruments, and then you can apply those to the scenario. Each time you get it right, you're earning marks. At the signing of the contract, there is no asset stroke liability because the value of the wheat is the value of the shares. How do we value derivatives? We value derivatives using the fair value approach. So at the SFP date, we revalue the wheat and Margie's shares, and the difference creates an asset stroke liability in the statement of financial position. Any increase or decrease in the year is taken to profit or loss. So I'm looking at that question, and one of the things I'm noticing all the time, one of the things I've got focus in my mind, it says 7 marks. How many points have I got down here? Well, it's not share-based payment is 1, it's not a hedge, and I've got 1, 2, 3 points. Derivative, got a couple of points at least there, so it's probably up to 5. Value at inception, value at SFP date, potentially I've got 7 marks. Potentially I've got 8 or 9 marks in practice, but that will be capped at 7. So that's part A. Break the question down, bite-sized chunk approach. Item B. We've got the Antalya purchase. If this is a 100% owned subsidiary, we made the purchase on the 1st of December X3, which is the start of the current year. And we've previously granted share-based payment to its employees. Okay, Antalya had done that. Its employees had rendered the required service for the award at the acquisition date, but had not exercised their options. So Antalya owes the employees in respect of the share-based payment scheme at the acquisition date. What has Margie doing? Well, Margie is obliged to replace that scheme with awards of its own. So Margie has a commitment to replace the scheme with its own, and therefore this will reduce the net assets of Antalya for goodwill purposes. The award by Margie is worth 22 million, and so it is this figure that is deducted from net assets. The increase in the cost from 20 million to 22 million is charged to the income statement. Antalya's employees do not have to do anything to earn the award, so nothing is charged to the income statement post-acquisition, because they'd already earned the award before coming. Actually, that should be the 20 million, because the 20 million is the amount that has been awarded by Antalya, and then we're going to give them an extra 2 million on top, so we charge the extra 2 million to our income statement. Again, the approach is get a point across, summarize it as briefly as you can, move on, put your answer across in bite-sized chunks. Next, we've got the Margie share issue. Notice some were given to employees and some were given to another party. Let's make sure our answer breaks it down into each component. First of all, to employees. This is a standard share issue. And is not linked to any vesting conditions. It is therefore outside of the scope of IFRS 2. Margie, and always try to refer to the company name on quite a few occasions in your answer. It just makes it slightly more personal. Remember, the person marking your paper is going to be marking hundreds upon hundreds of these, and if everybody just talks very generically, it becomes very boring. So if you can make it slightly more personal, you're more likely to earn those 2 professional marks. So Margie should therefore simply debit cash, credit share capital, and the share premium with the share proceeds. So that's in respect of the employees. We've then got Grief. Grief owns 5% of Margie's shares. Margie offered to buy a building from Grief and agreed that the purchase price would be issued by the issue of shares. This is a share-based payment per IFRS 2 because Margie is paying for a product stroke service, here it's a product, via an equity issue. Margie should therefore debit PPE and credit equity with the fair value of the building at acquisition date. So once again, the number of marks available is, in my head, it's dictating to me approximately how much I should write. Students often ask me, should I write pages and pages and pages? Work on the basis of 1 mark per point that you make. And what have I got here? 2 points for Grief, 2 or 3 points for the shares to the employees. I've covered at least 4 points there. Options to employees. The companies vest upon the company's share price reaching $15. So this is a market-based vesting condition because it relates to a share price target. And the employee's got to stay with us, that's fine. The terms and conditions are that the market condition can be met in either 3, 4 or 5 years service. So we've got a problem. Should we be spreading it over 3, 4 or 5 years? Well, it says at the grant date we thought it would take 4 years. So what was the grant date? At the grant date, 1st of the 12th X1, the expected vesting period was 4 years. Therefore, in the years ended the 30th of the 11th X2 and the 30th of the 11th X3, the expense charged to income statement or charged to profit and loss was, we've got 4,000 employees, doesn't look at any of them look like leaving. They're each granted 100 options and they've got a fair value of $10 each, and we're going to charge 1/4 of that. So 4,000 times 100 times 10 divided by 4. So it's going to be $1 million a year, which we will debit to profit and loss, 1 million, and we will credit to equity, 1 million. So therefore, the total charge to equity at the end of X3 is $2 million. At the 30th of November X4, we have achieved the share price target, and the scheme now vests. The total cost is $4 million. Because that's 4,000 times 100 times 10. We have already charged $2 million to profit and loss in previous years, and so charge the difference in the current year. So that's going to be debit profit and loss. The total cost is 4, we've already charged 2. Debit profit and loss 2 million. Credit equity 2 million.